Just like on the battlefield, there's a time to shake hands and kiss babies. There's a time to throw the kitchen sink with the water still running and the dollar soap at the bad guys. There's a time to eat, chow, and work out. Just like there's a time to use artillery, machine gun, or drop big bombs on those idiots. The stock market and the financial markets are no different. There's always a play out there. And if you don't understand it from a bigger picture, you're going to be buying Tesla as the market's crashing. Or you're going to experience a lot of tail risk in your trading. So that's what this class in this section is going to teach you how to do from a bigger picture level. And this will teach you whether it's a good time to buy a car, buy a house, or should you be paying off your debt and saving your money up. It will do the same in the market if you tailor your trades with how the central banks and the Federal Reserves think about and you'll know what sector to be in, what type of trading you should be doing, and how long you should be staying in a trade versus getting out of a trade. And it will just help you a lot. And we're going to do this from looking at like the bond market, right? We're going to start off discussing that. So there are two important ways to deconstruct the bond yield so you understand what is going on. Yield is the expected effect of something, and in the bond market, it is over time expected earnings as an interest rate or a percentage, right? So the first way we're going to look at it is the nominal yield, which is the real yield with inflation expectations. This yield represents how cheap or expensive things are. The inflation expectation allows commercial banks, aka the leverage, and companies to know how to adjust the cost of things. So if inflation is going down and you need to take a loan out, you have the advantage because inflation is low, so people have jobs, companies are charging less for goods and services, consumers are spending without credit, the dollar goes farther, and this means growth is happening at an even pace. Now, when growth starts to slow due to whatever event, let's take COVID as an example, we see loss of employment, and our monetary system tries to induce credit to consumers now to make money, not to make money, but to continue growth. Why? Because if growth slows, consumer spending slows, and companies charge more to less spending to make up for the lack of spending on goods and services. Now, at the beginning of the phase starts the wealth illusion. While the Federal Reserve is responsible for pricing and employment, when they induce spending with credit, it is the balanced pricing for the consumer. However, as the consumer swipes their credit cards more and more, because of the wealth illusion, companies start jacking the prices up due to demand. Now we are growing too fast and the dollar gets us less. And we spend less because we hit our credit limits, and now we have to pay them back instead of spend. Now growth slows and inflation is high, aka goods and services are overpriced, and this leads to people who can't afford to survive. And now they start breaking values, aka crime increases. Companies start laying people off and jacking prices higher to cover supply with no demand. To the Fed, they lower interest rates for banks to loan more to a consumer who is already maxed out on credit. So real yield plus inflation expectations equal nominal yield. And this helps our trading because if inflation is high, is there going to be growth in the tech sector, let's say? Probably not. Maybe the consumer staples, so it gives us a base to know where we should be at. Okay, so this is the introduction. I hope this helps. Later.